Hello everyone, welcome back. This is the second section of this series, Middle East Energy Shock, Macroeconomic Impacts of Rising Oil and Gas Prices. This section, I will examine how the 2026 Middle East conflict became a global energy shock with wide macroeconomic consequences. We're not just looking at oil prices in isolation, we're looking at how geopolitical conflict affects supply routes, market expectations, inflation, GDP growth, and policy choices. The key theme is that energy shocks spread far beyond the energy sector itself. Once oil and gas prices rise, the effects move into transport, manufacture, food security, trade, and financial markets. So this section links a regional conflict to a wider global economy, instability, and crisis. That shows why energy security matters so much. By the end of this section, we should be able to do this couple of outcomes. First, explain how geopolitical conflict creates instability in global energy markets through this conflict. Second, analyze why oil and gas prices rose during the 2026 crisis. Third, assess the macroeconomic effects of higher energy prices on inflation, import and export, interest rate, financial market, and ripple effects across the world. Fourth, distinguish between the effects on energy importers and exporters. Finally, discuss the policy problems created by conflict-driven energy shock. In other words, this section moves from the immediate market reaction to the wider economic and policy consequences of the energy shock. First, let us begin with an overview of the 2026 energy crisis. The immediate catalyst was the coordinated US and Israeli strikes on Iranian military and nuclear facilities, known as Operation Epic Fury, which began on 28 February 2026. The conflict then escalated when Iran retaliated against Israel, US bases, and Gulf targets, contributing to the effective closure of the Strait of Hormuz. At first, financial markets reacted cautiously. However, as the conflict moved into its third week with no clear sign of de-escalation, geopolitical risk and war fears were rapidly priced into global oil markets. As a result, Brent crude rose sharply above $100 per barrel, briefly touching $120 per barrel in early March before easing back into the $90 range, although volatility remains very high. This mattered because the conflict quickly moved beyond a local military event and began threatening one of the world's most important energy choke points. Once that happened, markets no longer saw this as just a regional war. They treated it as a global energy security shock. The core issue became the combination of war risk, shipping risk, and fear of supply disruption. This map shows the geographical spread of strikes by Iran and its proxies, alongside US and Israeli strikes across Iran, Israel, Iraq, Syria, and the Gulf region. It highlights how the conflict is not isolated to one location, but affects a wide strategic area, including key military bases and major energy shipping routes near the Gulf. This helps explain why oil markets reacted so strongly. The risk comes not only from actual supply loss, but from the wider threat to regional stability, transport, and energy security. This map shows U.S. military presence in the Middle East and nearby regions. Red dots mark U.S.-controlled bases that have operated for at least 15 years. Orange dots mark other sites with U.S. military presence. It shows bases or military sites across places such as Kuwait, Bahrain, Qatar, the UAE, Jordan, Iraq, Syria, Cyprus, Turkey, and Oman. So the main point of the image is to show how widely spread US military infrastructure is around Iran and the Gulf region. This slide shows the timeline of the crisis in Middle East. It shows how quickly the conflict escalated between 28 February and 3 March 2026. What began as Israeli and US strikes on Iran rapidly spread across the region with retaliations, attacks in Iraq and Lebanon, drone strikes, embassy threats, and wider military involvement. The most important turning point for the global economy was the announced closure of the Strait of Hormuz on 2nd of March. That transformed a regional war into a global energy shock because Hormuz is a critical route for oil and LNG exports. In other words, the timeline explains why market reacted so sharply and why economic risks rose so quickly. It presents the conflict as moving very quickly from an initial strike into a regional and global crisis. What makes this crisis so different from the oil crisis in the 1970s and others, including Russia and Ukraine war? This shock differs from earlier oil crises in several important ways. First, strategic oil reserves are much larger than in the 1970s, giving governments more short-run buffers. This can cushion short-term supply disruption. Secondly, the United States is now a major net energy exporter, which changes the global balance and the picture of a global supply and demand of oil. Thirdly, even without a complete physical shutdown, higher insurance costs, shipping costs, risk and danger, and military escort risks can create a functional blockade, especially around the Gulf. Fourth, the global energy transition means that in the medium run, countries have more scope to substitute away from oil. Modern markets react very quickly, so war risk is priced in before full shortage even appear. Finally, the energy transition happens in recent decades means that there are now more medium-run substitutes, such as renewable and electrification, even though short-run dependency remains very high. Why disruption in the Strait of Hormuz matters not only for crude oil, but also for the wider petrochemical industry. This map shows the Strait of Hormuz location, and the vessel flows have fallen by around 90% since the crisis, severely reducing transport through a key export route. The chart shows that before the conflict, the Middle East exports large volumes of petrochemical products and feedstock such as LPG, naphtha, methanol, urea, polyethylene, polypropylene, and MEG, all being affected. This means the shock threatens not only energy supply, but also chemicals, fertilizers, manufacturing input, and global industrial supply chains more broadly. Energy markets reacted strongly because traders feared both actual and expected supply disruption. The Strait of Hormuz is a vital choke point, as I mentioned in previous slides, for oil and LNG, so any threat to shipping there immediately affects global expectations. Markets also added a geopolitical risk premium, meaning prices rose not only because of physical shortages, but also because of uncertainty and risks. Insurance, freight, and security costs rose as well because oil demand is relatively inelastic in the short run. Even small disruption can produce a large price jump. That's why the market response was so sharp and why inflation concerns quickly generated. Markets feared disruption to major shipping routes, especially the Strait of Hormuz. At the same time, war risk pushed up insurance, transport, freight costs, and so on, and this created a risk premium. So oil price rose not only because of the actual shortage and oil itself, but also the uncertainty and expectations around the premiers. This map provides historical context for the current energy crisis by showing major oil facility and tanker attacks in 2018 to 2019 across the Gulf region. It highlights two of the world's most important energy choke points, the Strait of Hormuz and Bab el-Mandab, as well as major shipping routes and alternative pipelines such as the East-West Pipeline and the Abu Dhabi crude pipeline. The numbered instances show that attacks on tankers, pumping stations, and oil installations had already disrupted regional energy security before 2026. This matters because it reminds us that the Gulf's vulnerability is not new. It's historical. Even when physical supply is not completely cut off, repeated attacks can raise shipping risk, insurance costs, and market uncertainty. So the message of this slide under the map is that the 2026 shock fits into a longer pattern of geopolitical instability around the critical energy routes, which helps explain why markets react so quickly and strongly when conflict escalates in this region. Here is another map shows global oil shipments depending on major choke points. It highlights a major structural weakness in the global energy system. A large share of international traded oil and LNG must pass through a small number of narrow maritime choke points. Among them, the Strait of Hormuz is one of the most important. Located between Iran and Oman, it carried about 20.9 million barrels of oil per day in 2023, accounting for more than a quarter of global seaborne oil trade and around one-fifth of global LNG trade. Most of these flows went to Asian markets, especially China, India, Japan, and South Korea. This matters because energy security depends not only on how much oil is produced, but also on whether it can be transported safely and cheaply. Even if closure of Hormuz is considered unlikely, any serious threat can trigger sharp price rises, shipping disruption, and supply fears. This map therefore shows why conflict around the strategic transit routes quickly become a global economic problems. As the conflict between Iran and Israel and the US continues to escalate, the Strait of Hormuz has become a point of security among international observers. When there is a crisis, the market responds to the shock through oil price movements. This diagram shows the key point is that price reacts very quickly and sharply once conflict threatened Gulf energy flows and shipping routes. Oil markets are very sensitive to conflict in this region because supply is concentrated and short-run demand is inelastic. So the chart is evidence of how geopolitical events are transmitted into prices. It also reminds us that oil prices respond not only to current supply losses, but to expectations of future disruption. In that sense, the chart captures both the immediate shock and the market fear of what might happen in the future. Here are some historical figures. In 1990, following Iraq's invasion of Kuwait, oil prices surged by approximately 89%, only to reverse course and fall back by 57% within 9 months. In 2022, the outbreak of the Russia-Ukraine war sent oil prices surge to around $130 per barrel as markets grappled with the potential disruption of 7 to 8 MB per day of Russian supply, equivalent to roughly 7 to 8% of global output. As fears of sustained supply losses eased, prices retraced by roughly 43% over the following 18 weeks. During the 2003 US-Iraq War, crude oil rose around 24% before declining 33% over the subsequent 12 weeks. More recently, during the 12-day Israel-Iran confrontation in June 2025, started on June 13th, oil prices incorporated an estimated $10 to 15 per barrel risk premium, which dissipated quickly once it became clear that energy flows through the Strait of Hormuz would resume and that regional infrastructure had not sustained lasting damage. Overall, across the 10 major conflicts over the past 35 years, the average decline after the initial price spike has been in the order of 35%. The historical pattern is clear. While conflict injects an immediate and often severe risk premium into oil markets, that premium has often faded as fiscal supply disruptions proved less persistent than initially feared. This diagram shows the 2026 conflict created both a real supply shock and a strong market reaction. According to the IEA, around 8 million barrels per day were disrupted in March 2026, mainly because of the closure of the Strait of Hormuz and wider production losses across the Gulf. At the same time, oil prices jumped sharply as traders priced in war risk and future shortages. Brent WTI, which had been much lower before the escalation, surged to around 119 per barrel by 9th of March. Although prices later eased, they remained elevated. The key point is that this was not just market fear. A large physical loss of supply combined with uncertainty to create a serious and persistent global energy shock. Another low this level of oil prices during coronavirus pandemic in 2020. The pandemic resulted in crude oil prices hitting a major slump as oil demand drastically declined following lockdown and travel restrictions. Initial outlook and uncertainty surrounding the course of the pandemic brought about a disagreement between two of the largest oil producers, Russia and Saudi Arabia. In early March, bilateral talks between global oil producers ended in agreement on April 13th, with promise to cut petroleum output and hopes rising that this might help stabilize the oil price in the coming weeks. However, with storage facilities and oil tankers quickly filling up, fears grew over where to store excess oil, leading to benchmark prices seeing record negative prices between April 20th and April 22nd, 2020. How crude oil prices are determined. As with most commodities, crude oil prices are impacted by supply and demand, as well as inventories and market sentiment. However, as oil is most often traded in future contracts, where a contract is agreed upon while product delivery will follow in the next 2 to 3 months, market speculation is one of the principal determinants for oil prices. Traders make conclusions on how production output and consumer demand will likely develop over the coming months, leaving room for uncertainty. Spot prices differ from future insofar as they reflect the current market price of a commodity. This slide shows the policy response through emergency stock release. The International Energy Agency (IEA) announced a record release of 400 million barrels, including a large contribution from the U.S. Strategic Petroleum Reserve, to stabilize markets. The purpose was to reduce prices and offset lost supply. However, the slide also shows the limits of this response. Strategic reserves can smooth short-run spikes, but they work best if the disruption is temporary. If the conflict lasts too long, even large stock releases may not fully compensate for supply losses. So reserves are an important buffer, but they are not a permanent solution to a prolonged blockade. The IEA said the Middle East war had created the largest oil supply disruption in history, with global supply expected to fall by 8 million barrels per day in March, about 8% of the world demand. The main cause was the blockade of the Strait of Hormuz, while Gulf producers including Iraq, Qatar, Kuwait, the UAE, and Saudi Arabia had already cut output by at least 10 million barrel per day. The IEA warned that restoring shut-in production could take weeks or months even if conditions improved. The crash was also expected to reduce oil demand, with global demand during March-April projected to be around 1 million barrels per day, lower than earlier forecast. Despite the immediate shock, the IEA still expected the global oil supply to grow faster than demand over 2026 as a whole, partly because Saudi Arabia and the UAE were expanding export routes that bypass Hormuz. The blue figure shows how the IEA responded to the oil shock by announcing the largest ever coordinated release from global strategic reserves. Member countries plan to release altogether about 400 million barrels to stabilize the market. In the short run, this acts like an emergency increase in supply and helps reduce upward pressure on prices. However, reserves are only temporary buffer, not a permanent solution. International Energy Agency IEA has done the emergency release in history many times when oil price shocks alongside major movement happens. The right line tracks the spot price of crude oil over time, while the labels highlight key crises and policy responses. It shows that the IEA was created in 1974 after the 1973 to 1974 oil crisis and later intervened during major disruptions such as the 1991 Gulf War, Hurricane Katrina in 2005, the Libya conflict in 2011, the Russia-Ukraine war in 2022, and now the Iran war in 2026. The key point is that emergency release are used when supply shocks threaten the global economy. In March 2026, the release is proposed of 400 million barrel per day, um, 400 million barrel, and it's shown in this diagram. This suggests the current disruption is being treated as one of the most serious energy shock in modern history. The reason why the Middle East has such a large global appeal in oil crisis, the region remains structurally important to world energy supply, accounting for a major share of global oil production and a significant share of natural gas output. Key exporters are Saudi Arabia, Iraq, the UAE, Kuwait, and Qatar, depending directly on or indirectly on the Strait of Hormuz and related routes. This means regional instability quickly affects global prices, especially when markets fear disruption to export. The broader lesson is that the world economy remains heavily exposed to this region, not just because of production volumes, but because of the central role in export routes and energy trade. The situation of OPEC oil production in February 26 is shown here and compares actual output with agreed targets and spare capacity. It shows that total OPEC plus production reached 43.19 million barrels per day, slightly lower than January's 43.33 million. Within OPEC, the co-OPEC OPEC 9 members produced 24.02 million barrels per day, around 0.78 million above their implied target, mainly because Iraq, Saudi Arabia, and the UAE exceeded their quotas. By contrast, non-OPEC members produced 13.44 million barrels per day, about 0.74 million below target, with Russia especially underproducing relative to its quota. Overall, the broader OPEC plus 18 group remained very close to target, only 0.04 million barrels per day above the November 2022 deal level. Another key feature is spare capacity. Total OPEC plus effective spare capacity is estimated at 3.8 million barrels per day, concentrated largely in Saudi Arabia and the UAE, which gives the group some ability to respond to future supply disruption. This evidence shows not just a one-day spike, but a sustained war risk premium. Energy prices rose quickly, stayed elevated, and spread stress into oil, LNG, freight, and wider energy markets. Here is another diagram and map sharpens the argument by focusing on vulnerability. The Strait of Hormuz is not only important because of the volume of oil and gas that passes through it, it is also vulnerable because so much global trade depends on a narrow and politically sensitive route. That combination of high volume and high fragility makes it one of the most dangerous choke points in the world economy. A disruption here affects price, shipping, and market expectations almost immediately. So the key message is that the global energy system is not only interconnected but also exposed to concentrated geopolitical risks that can be triggered by conflict in one location. Shortly after the US and Israel launched strikes on Iran on 28 February, traffic through the Strait of Hormuz fell sharply. Repeated threats and attacks against the ships made the route functionally closed, with many tankers waiting outside the strait. IMF port watch data show that only about 6 ships per day passed through Hormuz between 1st and 8th of March, compared with around 100 ships per day in February, because around 50 to 30 of vessels there usually carry oil or LNG. Disruption has major consequences, since Hormuz handles roughly 20 million barrels per day. Fossil fuel import dependency is widespread. As shown in this map, around 50 countries imported more than half of their primary energy in the form of fossil fuels. The map highlights that many economies in Europe, Asia, and parts of Africa and Latin America remain highly exposed to external oil, gas, and coal supply. Countries such as Japan, South Korea, Spain, Morocco, and Turkey are especially dependent. This matters because when a major energy shock occurs, import-dependent economies face a stronger pressure on inflation, trade balance, and growth. In contrast, countries with more domestic supply are better protected. Fossil fuel import is very expensive. As in 2024, about 40 of the world's population lived in countries spending more than 3% of their GDP on fossil fuel imports, while roughly three-quarters of the global population lived in net fossil fuel importing economies. The diagram shows how costly this dependency is for countries such as Thailand, South Korea, Pakistan, Japan, India, Egypt, and others. By contrast, most exporters, such as Saudi Arabia, Nigeria, Canada, and Brazil, benefit from fossil fuel exports. The key message is that high energy import dependency creates major pressure on growth, inflation, and external balance. Too much dependence on oil export can sometimes create difficulties for oil exporting countries. So here is a diagram shows the main oil exporting countries. A study by Bloomberg estimated that in 2018, the most reliant country on oil export are Brunei and some others. Brunei has oil exports projected to make up over 60% of GDP. This will be nearly 15% more than the second most reliant country, Kuwait, and perhaps surprisingly, almost double that of Saudi Arabia. The slide also shows how strongly some economies, depending on oil export, could have troubles because the global economy can change very rapidly and the price can fluctuate. For those economies, oil is not just one sector. It is a major source of national revenue, exports, foreign exchange revenue, and fiscal stability. This matters in an energy shock situation because higher oil prices may bring short-term gains to exporters, but they can also increase volatility, fiscal dependency, and political risk. Why Iran matters in global energy market? First, the bar chart shows that Iran holds some of the largest proven oil reserves in the world, placing it among the top reserve holders globally. Secondly, the pie chart shows China absorbed the vast majority of Iran's crude oil and condensate exports, making Iran's export pattern highly concentrated. This matters because any disruption to Iranian production or exports affects not only regional supply expectations, but also China's energy security and wider Asian and global markets along the supply chains. This slide therefore links Iran's largest reserve with its continued importance in global oil trade. The map here shows Iran's largest oil and natural gas fields. As explained above, Iran is very central to any Middle East energy shock. It is a major producer of both oil and natural gas. It remains important even under sanctions, partly because China, the world's second largest economy, continues to buy significant volume of Iranian oil. The map also shows that Iran's largest oil and gas fields are concentrated in strategically sensitive areas near the Gulf. That means conflict involving Iran can quickly spread and risk fear of supply disruption, damage to infrastructure, and export delays. As a result, Iran has outsized influence on global oil and gas prices. China is the biggest buyer of Iranian oil. Here shows the position of China, which counted for around 91% of Iranian oil export, far ahead of every other destinations. Syria, the UAE, Venezuela, Iraq, Turkey, Malaysia, and Oman each took only very small shares. This matters because Iran's oil trade is now heavily dependent on one major buyer. It also means that any disruption to Iranian exports would affect China's energy security and Asian oil markets more than most other regions. The figure shows both Iran's continued role in global supply and the strategic importance of China, the world number 2 largest economy, and its importance in sustaining Iran's oil export. China looks to be an out-and-out winner. It has plentiful coal as well as a material domestic oil and gas resource and can leverage its dominant existing clean tech platform. That may, however, promote importing nations to invest in domestic clean tech value chain and manufacturing rather than simply swap one form of dependency for another. Since the 2026 Iran conflict, oil prices climbed back above $100 a barrel on Thursday, and the stock market fell after three more cargo vessels were hit by the Gulf and Iran's new supreme leader vowed to keep blocking the key Strait of Hormuz shipping route. As the diagram shows, the sharply Brent crude oil reacted to this conflict very quickly. Before the war escalated, prices were much lower, but once the market began pricing in supply disruption, shipping risk, and possible output cuts, oil rose rapidly toward 120 per barrel US dollar. The chart also shows that prices did not immediately return to normal. Instead, they remained elevated around 100 or above, suggesting a persistent war risk premium. The key lesson is that the shock spread beyond one day of panic. Oil markets remained volatile because the traders were responding not only to current disruption, but also to uncertainty about how long the crash would last. Here is another figure that shows how uncertainty in oil markets increased during the crash. The OVX index measures expected volatility in oil-related assets, so a sharp rise signals that traders expect much larger price swings ahead. For much of the earlier period, volatility remained relatively moderate, but in early 2026, the index surged dramatically, reaching its highest level in years. This tells us that the conflict did not just raise oil prices, it also made the market panicked and far more unstable and unpredictable. In economic terms, higher volatility increases risk, discourages investment, and reinforces the wider macroeconomic shock created by the rise in energy price. Another diagram shows how energy-related equities responded to the shock. The index had already been trending upward over time, but it rose much higher and quicker and sharper in earlier 2026 as the conflict pushed oil and gas prices higher. This suggests that investors expected firms in the oil and gas sectors as well as coal sectors to benefit from stronger revenues and profits during the price spike. In that sense, parts of the energy sector can become short-run winners during a geopolitical shock, even while the wider global economy suffers. This chart therefore highlights the uneven distribution of the gain and losses created by conflict-driven energy market disruptions. The overall trend is upward. The index started around 580 to 600 in 2021 and rise to nearly 1,600 by early 2026. So it's highly volatile. However, in the long run, the direction is up. The line moves up and down quite sharply, which suggests this sector is very sensitive to any changes and shocks in energy market. And then profitability, prices, policies, and geopolitical risks are also very volatile. An oil shock can cause global ripple effect. This is a spread of oil shock far beyond the energy market. A disruption in one key region, such as the strategic route of Strait of Hormuz, can quickly affect shipping, fuel availability, and business confidence across the world. Through the bullwhip effect, firms respond by stockpiling, rerouting, and placing larger orders, which makes a shortage and delays even worse. And this could be affected both in downstream and upstream sectors. as transport and the production costs rise, inflation increases, and economic growth weakens, especially in energy importing countries. Financial markets also react vehemently um, because of the shock and can be very volatile, raising the risk of stagflation. So what begins as a regional supply disruption can ripple through trade, logistics, prices, input shortage, freight volatility, and higher consumer price, as well as inflation. Here is an example of Australia economy react to oil shock. So some major sectors are being affected significantly, causing ripple effects. The aviation industry has Qantas and Virgin Australia are forecasting airfare increases of 10 to 20% to offset the 40% jump in jet fuel costs. Agricultural and mining industries are key sectors that are the largest consumer of diesel consumption. High prices and supply uncertainty have triggered localized diesel rationing in Western Australia and Queensland. Consumer inflation is followed. Logistics and freight surcharges are expected to rise, adding roughly $24 per tank for the average motorist. And Australia government also initiated a strategic shift uh, as the government start looking for alternative supply routes and reconsidering domestic refining or storage capacity. The key lesson is that energy shocks affects governments, firms, households, and government policies simultaneously, forcing both short-run adjustment and long-run strategic changes. These two figures shows how the shock spread through the economy and also highlights a breakdown of the transmission mechanism of the shock. First, energy importing economies scramble to secure alternative supply, raising energy security pressures. Secondly, transport costs rise because shipping, air freight, and road haulage all become more expensive. Third, higher fuel and energy prices raise input costs for farming, manufacturing, and logistics. Fourth, governments may face fiscal pressure if they try to shield households, while weaker currencies can worsen imported inflation. Finally, financial markets will react to higher stagflation risk, increasing volatility. So the side shows that the shocks rise through multiple channels at once: trade, firms, production, food, transport, manufacturing, public finance, and expectations. Then who is the one being hit hardest, regional or sectoral impacts? So the impact is uneven. Energy importing manufacturing economies are usually more exposed, while exporters may benefit from higher prices, at least in the short term. Sectorial exposure also differs, with transport and energy-intensive industries often hit first. Here, this information shows that the effects of the shock are very uneven, and while emerging Asia is quite vulnerable because many countries in this region depend heavily on imported oil. Low-income importers also face especially severe pressure on inflation, so foreign reserves and exchange rate, such as some of the Southeast Asian countries or South American countries. In sectorial aspects, airlines, as we mentioned earlier, and shipping freights, chemical, heavy manufacturing, agricultural, and other energy-intensive industries are among the hardest hit. So at the same time, there may be relatively winners mainly at the oil and gas exporters, energy companies focusing on energy production, and over the long run, part of the renewable energy and EV sectors might benefit from this oil shock as well. The situation with Asian countries is quite severe. In the past 2 decades, oil consumption has exploded in countries like China and India, where expanding middle class have driven large-scale economic growth. China's demand for oil has nearly tripled over that period. During this time, the United States remained the world's largest consumer of oil, going through tens of millions of barrels a day. Here, the figures show how strongly Asian oil demand has grown over the last few decades, especially in China and India. The Chinese the sharp upward trend in Chinese demand is particularly striking, with India also rising steadily. Other countries, such as Japan, South Korea, and Saudi Arabia, remain important consumers, but their growth is much slower. The key message is that Asia has become increasingly central to global oil demand and supply. This matters because a disruption in Gulf exports through the Strait of Hormuz does not just affect producers, it directly threatens the energy security of the world's most important demanding region. Winners and losers of the oil shock. To summarize, the winners would be some of the upstream energy firms, part of the defense sector actually, and some oil exporting economies such as Russia and Venezuela, which had suffered for few years of oil sanction. And in some cases, part of the renewable energy would benefit. By contrast, the main losers are industries that depend heavily on fuel and transport energy sectors, such as airline, chemical, logistic, discretionary retail, and heavy industry. The country examples make the same point. Exporters are Canada and Norway may benefit, while major importers like Japan, India, and many EU economies face a stronger economic pressure. In Europe, Europe's industry base is having a bit of a split screen moment. On one side, chemicals, metals, and other energy gasoline stalwarts all are still reeling from high gas prices and now starting uh, to go down. Another squeeze as oil and natural gas jump on the back of the war in the Middle East. On the other hand, weapons, planes, and anything with a defense budget attached would benefit. These are quietly or booming actually. The latest Eurostat data captures the divergence very well. Eurozone industrial production fell 1.2% year-on-year in January, with chemical output down a chunky 6.6%. Meanwhile, production of weapons and ammunition jumped 31% to a record high. Aerospace is having a moment, with Eurozone output up 15% on the year to January and posting double-digit growth in most recent months. This chart shows that not all manufacturing sectors are affected in the same way by geopolitical and energy shocks. As I mentioned earlier, weapons and ammunition sectors are benefiting from it, as shown in the upwarding slope of the blue and the pink curves. Comparing short run and long run effect of the oil shock, there are different effects. In the short run, higher oil and gas prices raise firms' costs, reduce output, and increase inflation because wages, contracts, and supply chains cannot adjust quickly. the economy faces immediate disruption and uncertainty. In the long run, however, firms and governments may adapt by improving energy efficiency, diversifying suppliers, investing in renewable, and strengthening energy security. Expectations are also important. If households and firms believe high energy prices will last, inflation becomes harder to control. So while the shock is initially disruptive, it can also drive long-term structural change. Global shipping and logistic disruptions, showing here in this figure. The Iranian conflict has caused growing disruption to global logistics, with the biggest immediate effects seen in fuel cost and air freight capacity. Air freight has been hit hardest because major Gulf hubs such as Dubai, Abu Doha, and Doha are key transshipment centers for trade between Asia and Europe. Reduced capacity, longer routes, and rising fuel costs have pushed freight rates higher and made prices more volatile. Ocean freight has also been affected, especially with the Strait of Hormuz effectively closed, which has severely disrupted shipping into and out of the Gulf. Although base ocean freight rates have not risen sharply yet, higher bunker costs and possible general rate increases are expected to raise costs further. Road transportation is also under pressure, as rising diesel prices have increased fuel surcharges. At the same time, cargo insurance have become more expensive and difficult to obtain, especially for Gulf-related transportation and trade, as insurers are reluctant to insure for those trade, reduce or withdraw war risk coverage. In the meantime, the conflict also affects both consumer fuel prices and global trade routes. On the left diagram, fuel prices rose across many countries. Through the size of the increase varied, the Philippines, Nigeria, and Australia saw especially large rises, while countries such as China, Japan, and the UK experienced smaller but still noticeable increase. On the right, the trade volume chart shows how traffic shifted across major choke points, such as the Strait of Hormuz, Red Sea, Bab al-Mandab, and Cape of Good Hope. Together, the charts show how war-driven disruption raises domestic fuel costs and forces global trade to reroute. Global economic comment and economic impacts of the war in Iran. Here the slide under the diagram summarizes the broader macroeconomic consequences of the conflict. The message is that higher oil prices tend to raise inflation and slow economic growth. At the same time, the information argues that markets were pricing in several more weeks of disruption in the Strait of Hormuz, which kept oil prices elevated even if a full closure was not guaranteed. The diagram shows that the likely effects of higher oil prices on GDP and headline inflation across different economies. In general, strong oil prices reduce growth modestly but push inflation upward, reinforcing the stagflation risk created by energy shock. The figure shows the disruption in the Strait of Hormuz could trigger many simultaneous global shortage. So 7 of them are presented here. These are commodity supply chains originated in the Persian Gulf region, either through direct production or as byproducts of oil and gas extraction and refining. And if the closure of Hormuz continues, several of them will face shortage crises that will compound day by day. These are crude oil, LNG, phosphate, helium, ammonia, sulfur, and urea, because many of these supplies are produced in or processed in or shipped through the Gulf, the Strait of Hormuz. A prolonged closure would spread far beyond energy into the related industries, including agricultural, chemicals, plastics, pharmaceuticals, and manufacturing. The figure just highlight the share of global supply sectors at risk, with the highest exposure in urea and sulfur. The broader message is that when regional war can create cascading global supply shocks, worsen food security, raise prices, disrupt trade, and deepen financial and geopolitical instability worldwide. Regarding food and fertilizer, Gulf disruption puts global fertilizer supply at risk, as shown in this diagram. Since February 28, 2026, commercial shipping through the Strait of Hormuz has been severely disrupted. So, because this route is vital for energy and bulk commodities, the, this matters for many trade, including fertilizer trade. Around 20% of global seaborne fertilizer exports come from the Arabian Gulf, and about 46% of global area trade is linked to Gulf producers. Major importers include India, Brazil, and China. If disruption continues, fertilizer shortages and higher prices could raise farming costs, reduce food production, and increase global food price, and can cause food shortage, especially in more vulnerable and import-dependent regions. Monthly price for fertilizers from January 2022 to February 2026 shows an energy shock can spread into agriculture and food markets. Gulf disruption threatens the supply of the key commodities in agriculture, which higher gas and transport costs, raising the fertilizer price more broadly. Because fertilizer are essential input in modern farming, higher price therefore increase production cost and may cause some farmer to reduce usage. That can lower crop yields and push food price higher later on. The most exposed countries are lower-income importers that depend heavily on imported fertilizers and already face food security risks. The overall information presented here is that energy shock, again, is very severe and would not stop at fuel markets alone, will feed into food inflation. The Iran conflict crisis affected a wide range of asset prices as well in the financial market. So it's not only oil. WTI crude, Brent crude, and natural gas rose strongly as a consequence, reflecting tighter energy markets and higher war risk. At the same time, some stock indexes and the precious metal performed more weakly than many investors might expect during a crisis. This suggests that markets were reacting less like a classic safe haven episode and more like a shock centered on energy and growth risks. The diagram here highlights the unusual pattern of this crisis. Energy prices surged, but broader financial responses were more mixed. How long would the country's oil stock last? This is another vital question that relates to oil shock. Strategic oil shocks of net importers by how many days of average supplemented consumption they could cover. So this figure shows the related oil stock in different countries. Countries such as Japan and South Korea appear relatively well protected, while others such as Australia and New Zealand have much smaller buffers. The reference to the IEA's 90-day requirement is important because it shows the minimum preparedness expected from member countries. The key message is that stockpiles can buy time during an energy crisis, but protection is uneven, and some import-dependent economies are much more exposed than others. As oil shock effects spread, it becomes from macro to micro level transmission channels. An energy shock becomes a macroeconomic problem. In the short run, oil demand is relatively inelastic, which means consumers and firms cannot easily reduce usage when prices rise. As a result, even small supply losses can cause large price jumps. Higher energy price raises firms' marginal cost, especially in transport, manufacturing, and logistics, while households face higher fuel and utility bills. These effects then spread across the economy through prices, incomes, and expectations. The key information is that a shock that begins in one market quickly affects inflation, real income, and economic growth across the wider macroeconomy. Showing here is the ASAD model to explain why an oil shock can produce stagflation. Rising energy prices increase firms' cost of production, which shifts short-run aggregate supply (SRAS) from 1 to 2 to the leftwards in the diagram. This raises the general price level while reducing real output. That is the classic pattern of a negative supply shock: more inflation but less growth. The diagram also emphasizes that this is not caused by excessive demand or too much money, but by more expensive inputs such as transport and energy. The key message is that conflict-driven oil shocks create a difficult combination of higher prices and weaker economic activities. The situation is a typical cost-push inflation in the context of an energy shock. Prices rise because production becomes more expensive, not because demand is booming. Higher oil and gas prices rise the cost of fuel, electricity, transport, and raw materials, which then affect both firms and households' consumptions. The information here separates the transmission into three parts: direct effects on household energy bill, indirect effects on firms' fixed cost and variable cost, particularly transport and production costs, and imported effects for countries that buy energy from abroad. In macroeconomic terms, this pushes SRAS left, leading to higher inflation and lower output. The diagram reinforces this relationship between stronger disruption and weaker growth. Stagnation risk is very much associated with energy shocks. The definition of stagflation means when it occurs in the situation when the economy experiences stagnant economic growth, but higher employment and higher inflation simultaneously. The 2026 oil conflict triggers is unlike normal inflation caused by people spending too much. This should be demand pull inflation. The differences is the 2028 triggers cost push inflation. Oil is a universal input. When prices hit 120 US dollar per barrel, the cost of producing everything, not only oil itself, but basic means like bread and fundamental production like fertilizer and transportation to unnecessary luxury items such as iPhone can skyrocket. The result is businesses pass costs to consumers, price goes up while cutting production and staff in order to survive, therefore causing growth reduce. How much has the Middle East energy system been disrupted? As shown from above information, the disruption is not marginal but systematic. Israel shuts the Leviathan and Karish gas fields early in the conflict, while missile and drone strikes hit oil fields, refineries, and export facilities across the Gulf. Around 11 million barrels per day of oil supply have been disrupted, and regional exports have fallen by more than 50%. That means the shock is affecting both production and transport. The information here presented shows the scale of the macroeconomic loss. More than 10% of global oil production has been shut in, and around $30 billion in oil reserve have been delayed. So output and growth impact of rising oil and gas prices can lead to slower GDP growth, as well weak consumption, including the household spending on more of the necessity things, such as fuel, electricity, and heating. And also, this can cause reduced investment because higher costs and greater uncertainty make firms more cautious to invest. Businesses may delay expansion, hiring, or capital spending. Also, higher interest rate can also make borrowing more expensive. And finally, possible recession risk. If inflation stays high while growth slows sharply, the economy may weaken further and further. A prolonged energy shock will increase long-term uncertainty and the risk of recession. The danger is greater in economies that are highly dependent on imported energy. So recession fears versus economic panic attack. As two competing interpretations of the crisis generate, the bear case argues that higher energy costs combined with an already cooling labor market raise the risk of recession. Prediction markets and investors therefore began pricing in a much higher probability of economic slowdown. The bull case argues that markets may be overreacting and that the economy still has some resilience, supported by productivity gains and wage growth. The diagram here shows the two reinforced points. Inflation was already above target before the Iran war, so the oil shock arrived on top of an existing inflation problem. This is in the US, UK, and some other oil generating countries. This is why markets reacted very nervously to the escalation because of the fear already were in place and fear for future further uncertainty. The rise of the security premium. The oil prices are now driven not only by basic supply and demand, but also by growing security premium to cover the possibility of risks. Markets increasingly price in the risk of a conflict, insurance disruption, shipping security, and choke point vulnerability. The argument also goes further. Repeated energy security crises may push countries to build more domestic energy capacity, renewable, nuclear power, and storage. In that sense, the premier is not only about short-run war risk, it's also about long-run restructuring. The key focus is that energy systems are being repriced around resilience and security. Efficiency alone is no longer enough in a world of repeated geopolitical shocks. When energy supply becomes insecure because of war, choke points, sanction, or shipping risk, buyers are willing to pay extra for oil and gas. That actual amount is the security premium. So the price of oil is no longer just based on normal supply and demand. It becomes oil price equals normal market fundamentals plus security and geopolitical risk premium. And basically, they are paying more not only because oil may be scarce, but because they are afraid it may become harder, slower, or riskier to get. So fundamentally, what problems have the war exposed? The deeper structural weakness revealed by the conflict, the vulnerability of economies that rely heavily on imported oil and gas, and also the ripple effects to not only oil importing but oil exporting countries and the world economy. The Iran war follows closely after the Russia-Ukraine shock, and both crises show how easily geopolitics can disrupt supply, raise prices, and create extreme volatility. The Strait of Hormuz blockade has pushed up oil and LNG prices, and those wholesale price increases flow quickly into transport, electricity, bills, heating, food, and manufacturing. The burden does not fall equally. Import-dependent countries face much greater pressures and inflationary and external pressure. So the real problem exposed by the war is excessive dependency on insecure foreign energy supply. Uh, in order to react to the situation, the policy need be particularly adjusted and in order to mitigate the uncertainty as well as the tension created through this crisis. So a few particular exposed import-dependent Asian countries have taken emergency demand-side measures, mandatory work from home, and fuel rationing, industrial users facing curtailment, orders with essential sectors prioritized. This is the thin end of the wedge. In the next 2 to 3 months, shortages will ripple out through Asia and into Europe and even the US. Europe and Asia will become increasingly reliant upon their strategic reserves to sustain supplies of oil and refined products. In the power sector, most countries have alternatives to keep the light on, more coal-fired generation and nuclear plants running harder, but these measures are minor adjustments to the immediate crisis and can only be a temporary fix. The slide summarizes top policymakers faces many different problems at the same time. This include they need to buffer the shock using tools such as strategic reserve, spare capacity, and emergency supply measures to reduce short-run volatility. But this, again, could be only temporary as long as the crisis is prolonged, the disruption will continue. Secondly, central banks face a classic dilemma. Rising oil and gas prices push inflation up, but the same shock weakens output, employment problem, and confidence of business investment. If rates are cut too soon, inflation expectations may become unanchored. If rates stay high for too long, recession risk increases. That's why the best response mixes temporary buffers, targeted fiscal support, and long-run diversification. Given this information and consideration, the question is there a sustainable solution? The key argument is that the long-run solution is to reduce dependency on imported oil and gas through different approaches, including electrification, renewable energy, and a stronger domestic energy system. So in practical terms, this means move to EV cars, more renewable generation such as nuclear power, stronger grids, and broader energy diversification. However, the information also indicates that this cannot happen very quickly or very shortly. Large-scale transition need time, capital investment, infrastructure building, and policy commitment. In the short run, countries may still remain dependent on fossil fuels and may even use more coal or backup fuels if disruptions continues. So the key information consideration is a balanced, a sustainable solution exists, but it is a long-term structural adjustment rather than an immediate crisis quick fix. To conclude this section, here are some review questions, including question relates to if the 2026 shock exposed the weakness of just-in-time global supply chains. Will high oil prices speed up the green transition or make it harder to fund? Should central banks fight inflation first, even at the cost of a slower growth? And finally, can non-OPEC Plus producers prevent a deeper global downturn if Hormuz disruption persists? Some of the suggestions of the answers could be found in the presentation itself. So in conclusion, the 2026 Iran and Middle East conflict turned a regional war into a global energy shock. A Strait of Hormuz disruption raises oil price, gas price, shipping cost, and insurance costs. This pressure spreads through inflation, weaker growth, and policy uncertainty, and leading to macroeconomic problems. Net importers suffer more, allegedly, from internal and inflationary pressure, while exporters might gain more revenue in the short run, but also remain exposed to volatility of the market. In the short run, policy can soften the shock, but not eliminate it. In the long run, the crisis has strengthened the idea and the case for energy transition, diversification, resilience building, and strategic security. Thank you for listening. The idea that oil shocks are never purely regional. They are always embedded in global power and trade relationships. While in an increasingly globalizing world, this become a more and more very connected situation. Thank you for listening. Please stay with me for the next part. I explain and elaborate detailed information regarding oil shock on different individual countries.